Hey everyone, Eric here. In this video, I'm going to teach you about the 7 most important SaaS metrics that you can use as a framework to track the financial performance of your SaaS startup. We'll walk through every single metric, what it means, how to calculate it, and at the end of this video, I'll show you how to write an investor update using all of this data. Okay, let's get started. Okay, so the structure of today's video is that we're going to walk through the 7 most important SaaS metrics that you should be tracking if you're running a SaaS startup. A lot of founders had asked me sort of how do I set up a comprehensive financial framework so that I can understand the performance of my SaaS business and make sure that everything's going well. So this is sort of a roadmap for people to run their own SaaS startups internally and also to be able to articulate the performance of the business externally to investors or if you're doing fundraising. So here are the 7 things that we should track. It's number 1, MRR and ARR. Number 2, growth rate. I'll talk about a couple different ways you can report growth rate numbers. Then MRR dynamics. So there's new revenue, churn revenue, expansion, and contraction. So you need to be able to tell the story of the composition of your revenue changes. Then, of course, you have customer lifetime value, how to calculate that. Your customer acquisition cost, so your CAC, and then LTV to CAC ratio. Finally, your burn and your runway. So how much money do you have until you run out of cash? And then financials. A lot of early stage businesses don't necessarily have very robust financials, but you do need to report some information about your financials versus your historical performance or your budget. So I'll show you how you can start thinking about that. And then at the end of the video, we're going to take all of these metrics and summarize them into an investor update you could send out at the end of the month to your investors. Okay, let's get started. So first off, MRR and ARR. So MRR stands for monthly recurring revenue, and ARR stands for annual recurring revenue. So you should be tracking these numbers weekly, monthly, definitely annually, as frequently as possible. This is really sort of the lifeblood of a SaaS business. So what is included in recurring revenue? So recurring revenue is any subscription-based revenue. What is not included is any one-time revenue like implementation, some kind of consulting, etc. Do not report that in your recurring revenue. So if this is your revenue, you'd have basically a breakdown between your recurring revenue and your one-time revenue. And so your total revenue would be $67,000. Your monthly recurring revenue would be $52,000. And then your ARR is your monthly recurring revenue times 12. So that's 631. So what that means is basically if you did this prior month, which is April 2024, for 12 months in a row, how much recurring revenue would you have on an annualized basis? So if you just did this month for 12 months without it increasing or decreasing, you'd be doing about $631,000 a year of recurring revenue. And so it just gives you sort of a run rate metric. And so that's what ARR is. So let's write the first couple bullet points in our investor update so that it's basically already written by the time we get to the end of the video. So very simple. Current MRR, we would just say 52,629. ARR is 631,524. And then we can say April total revenue was actually 67,007, but that includes implementation fees. So remember, your ARR does not include one-time revenue. So if you just take your total revenue and multiply it by 12, that is not your ARR, and investors will look into this. Your ARR is not 800K. 631. Investors will look into this in diligence and they will find out if you miscalculated it. So you want to make sure you do that correctly. Okay, so now let's move on to growth rate. So there's a couple different ways you can think about your growth and report your growth. And especially if your business is growing very quickly, you need to think about how you can really represent the story in an accurate way. So growth, you should obviously look at this monthly, annually, and in the very early days, weekly, if possible. So first you have month over month, you have year over year, and you have compounded monthly growth rate. So let's start with month over month. So month over month, you're just going to want to use your recurring revenue for your growth rate numbers. that's the number that investors really care about. And so we're saying that these numbers are going back historically, and we are in April 2024. And then, we can just say that these are a projection after that. So you can see that our month-over-month growth rate was in the 40s, and then it slowed down as our number got bigger and bigger. And in April 2024, we had a 22% month-over-month growth rate. So very strong month. Now we can also talk about year over year. So you can't measure year over year until you actually have a year of data. So January would be the first month where we can actually look back a year. And so year over year growth rate is 1,400%, which again, that's good, but the denominator is so small that it doesn't give you a great sense of really what's going on. Here in April, the 610% growth rate is based on last year's 7,409. So that's a little more, I think, interesting. So it shows we've done a 6x year over year. Now, my favorite growth metric is something called compounded monthly growth rate. This provides you an average rate of compounding over a period of time. And so let me show you how to do this, and we can talk about kind of what it means. Okay, so we're going to go to July. And so we're looking at the 6-month period, 1, 2, 3, 4, 5, 6, between July and January. So what we're going to do is we'll take July, we'll divide it by January, and then we will raise it to the power of 1 divided by 6, and we will subtract 1. So this means that if we started with this number in January, this number compounded at an average monthly growth rate of 31% to get to the 12,000 number in July. And I can prove that to you here by showing you what happens if we take January and we compound it at 31%. Compounded at 31%. And so if we just compound this number at 31% all the way out to July, you'll see that we get to this 12,110. So on average, we're compounding at 31%. And so if we copy this formula forward, you'll get a sort of average monthly growth rate over time. And you'll see that by April, our CMGR for a 6-month trailing period is 15%. Now you can also do CMGR for a 12-month period. And so it's the same formula, but just with a 1 divided by 12. So you look at a 12-month period, and you raise it to the power of 1 divided by 12 minus 1. And you can see that on average, over that 12-month period, our revenue is compounding at an average monthly growth rate of 25%. And then later on, it gets lower and lower. So we're really looking at April. So I think from a CMGR standpoint, the 12-month CMGR kind of gives you a good view on older businesses, 5, 10 plus years old. But for a really early stage business, probably the 6-month CMGR gives you a better read on the growth. 22% growth is good, but this 15% smooths out all of this volatility. Also, the 6x year over year, that is helpful in terms of a backward-looking metric, but I don't know that it really tells us what's going to happen going forward. And so I think the 15% gives us kind of the best read on the overall status of our business's growth. So what can we say here about the business growth? I think we can say that, recurring revenue is up 22% month over month, 610% year over year, and has compounded monthly at 15% CMGR over the last 6 months. That kind of encapsulates all of the growth metrics in one bullet point that investors can read quickly. Okay. I just want to take a pause really quick. First off, if you're finding this content valuable, please subscribe to my channel right now and like this video. One other thing, I want to let you know that registration is going to be opening soon for my training program, Finance for Startups. If you don't already know, Finance for Startups is a training bootcamp I designed to teach you everything I know about startups. It includes 20 hours of lectures, 5 hours of live case studies and open Q&A sessions, lifetime access to our community that recently surpassed 200 people, and I'm adding new things to it all the time. If you're interested, join the waitlist in the description below for a chance to join Finance for Startups. So now let's look at the next thing. So now let's talk about our MRR dynamics. So there's really 4 categories of MRR. There's new revenue that you brought on. There's churned revenue, which is basically cancellation of accounts. There's expansion, which is upgrades of accounts. So that's increasing the number of seats, increasing the number of usage. So paying more to basically keep using the software. And there's contraction, which is basically people downgrading but not churning. So you need to basically talk about the changes in your MRR by breaking it into these 4 categories so you and investors can really see what's going on. Okay, so you should track all of these numbers sort of on a monthly basis and weekly if you're really early stage. So first, let's talk about the churn rate. So we're saying that in March, we had 1 cancellation and we brought on 2 new accounts, and by the end of the month, our total active accounts were 33. And we're saying that the churn rate was 3.1%. So that's 1 cancellation, and then the total active accounts at the end of February was 32. So the 1 divided by the 32 is the 3.1% churn rate. Now in April, you can see that we had 1 cancellation, we earned 3 new accounts, and so our churn rate is the 1 cancellation divided by the prior month total, not the current month total, because the prior month is really the group of customers that were eligible to churn. So 3% churn rate. Okay, now we have the rest of the categories. So we have our MRR from up above, monthly recurring revenue. So one thing that's good to look at is your net new MRR. So how much new MRR did you bring in month over month? So I'm going to take the February number. So in March, we brought on 2,800 of net new ARR. In April, we brought on 9,490 of net new MRR. Now for me, this number is a little bit hard to conceptualize. So I like to actually look at the metric as net new ARR. So you just take this number and you multiply it by 12. And so this is how much annual recurring revenue you brought onto the business. So if we brought on 9,500 in MRR, really we expect that we brought on 114,000 of annualized revenue to our business. And so that gives you a better sense of, wow, April actually was a really big month. It really contributed to the overall performance of the business. Now here you can see expansion MRR. So we're saying that these are upgrades. So these are people that are purchasing more seats, etc. for April. And so April, a lot of expansion revenue, 5,500. Overall revenue increase was 9,500, and more than 50% of it came from expansion. So that is really, really positive. And then contraction, you have downgrades. So these are people that are downgrading their accounts, and then complete cancellations. So we lost 800 of MRR in March, 950 in April. And then the new business MRR. So this is just basically how much of that revenue, of that 9,500, came from brand new customers. And so basically 5,200 of it was from new customers, 5,500 of it was from upgrades, and then we lost 1,200 from contraction. And so you can see that adds up to 9,490. And so that's kind of the breakdown of what happened with our MRR. So you can just copy this formula over here. And then to really compare it side by side, there's a nice chart that a lot of people like to make. So here's what the chart sort of shows you. So you have your new MRR. And so this is MRR from basically, new business, brand new accounts. You have your upgrades, downgrades, churn, and then your overall change. So that's your sort of net new MRR. And so a lot of businesses will show this, but over many, many months, they'll have it going back like 18 months. But they'll show it on a chart that looks kind of something like this. I'm just going to do this in a basic way, just so you kind of have a sense of what the chart generally looks like. So let's see, cluster column. Yeah, it usually looks something like this. And so you'd see like MRR breakdown. And what this would show you is the line here is sort of your overall MRR. So your new MRR was 2,800, and then it was about 9,500. And then you can see these are all the things here on the positive side, your upgrades and your new business that increase your MRR. And below you can see the downgrades and the churn. These are the things that decrease your MRR. So it's good over time, and you can see this kind of big chart with this line overlaid over on the top of it that shows the overall change. And that's a nice way to summarize your MRR performance. Okay, so investor update. So overall, I would say very strong month. Onboarded 3 new large accounts. You can see we onboarded, over 5,000 of revenue, so those are larger accounts. Drove significant expansion revenue and onboarded 113,885 of net new ARR. So that's a nice metric right there. Okay, what else? We tripled expansion MRR month over month. So pretty much tripled it. You can see here, it's up 2.6x. So we tripled expansion MRR month over month, closing over 5K in upgrades for April. And then contraction, contraction MRR downgrades were low at a mere 296 versus 335 for March. And then we did have one account cancellation. Was a smaller account. You can see we only lost $950, driving $950 in churned MRR at a 3% churn rate. So that should give investors a very good sense of sort of where we're at with MRR. Okay, so now let's talk about customer lifetime value. So how often should you track customer lifetime value? Monthly is probably best, but don't wait around. The times where you should track it more often than monthly are situations where your churn rate goes up really, really fast, or your AOV goes down really fast. So you want to know if your LTV is getting worse, that how much you can continue to spend on marketing. So here's how you track the customer lifetime value. So we have our churn rate. So the customer lifetime value represents the total gross profit you make from one customer over their entire relationship with your company. And so you need to figure out how many months they're going to be a customer, how much they're going to spend per month, how profitable is that revenue stream, and then how much is all of that gross profit added up. So let's look at this. So first off, 3% churn rate, 3.1% churn rate. Basically, how you figure out what the customer lifetime is you take 1 divided by the churn rate. It's a mathematical shortcut, and it'll tell you that the average customer who churns at 3.1% a month is going to have a 32-month lifetime. And then in April, we're saying that the churn rate went down slightly, so the average customer in this cohort is going to have a 33% customer lifetime. So the AOV per month, well, we know what customers are spending because we have our MRR divided by total customers. And so we're saying in April, our AOV is going up, driven by that expansion revenue. Then your lifetime revenue is total months times revenue per month. So 49K versus 41. Gross margin we can get from our financials, which we have down below. So we have our total gross profit divided by revenue. So that's your gross profit margin, 88% versus 87%. So we're saying our total lifetime revenue times the gross profit margin is basically your customer lifetime value. So we're saying 44,000, and it looks like that's up month over month in terms of our estimate. Okay, so what can we say? We can say continued expansion revenue and reduced churn have increased our LTV estimates significantly. Based on April metrics, our LTV we project to be 43,889, which is 21% higher than our March projections. Okay, so very strong here. Okay, CAC and LTV ratio. So this is how much profit you make off one customer, but you are going to be needing to invest a bunch of money in the acquisition of that customer in the beginning. So you want to have to acquire basically a fraction of what you'll make back in LTV. So you don't want your customer acquisition cost to be too high, but you also do need to understand how much do you spend in marketing versus how much do you make back in profit on that customer. And so that's what we're going to look at here. So CAC and LTV ratio. Okay, so this CAC is oversimplified. If you have a really good CRM, you'll have better data than this, but I just am mostly doing this as a demonstration to show you how to calculate LTV to CAC. So here's some data here. We're saying that leads generated 52, 69. Then we had a conversion kind of from lead to sales meeting, and then sales meeting to customers acquired. So we know we acquired 2 customers and then 3. And then we have some financial data, ad spend, sales team compensation, other marketing. And so we're saying that our acquisition costs are 17,500, and then they're about 22,000 here. And so we would want to have other metrics. Again, probably the leads that we're generating in April aren't actually driving the conversions in April. Probably the conversions in April are from leads in a prior month, and the leads in April are for conversions in a future month. But just to keep it simple, it's good to report metrics like cost per lead, cost per meeting, so you can understand top of the funnel, mid funnel, and then the conversion is bottom of the funnel. So customer acquisition cost, we're saying, is the total sort of marketing activity divided by 2 customers acquired. And here it's 3 customers acquired, so 7,300 versus 8,800. And so if we spend 7,300 to acquire a customer, and then after we've acquired them, we expect to make 44,000 of profit, our LTV to CAC ratio is 6, and in the prior month it was 4. 6 is a very strong number, especially for an early stage company. 5 and up is very, very strong. And even 3 and up is still pretty good in the early days. So, okay, investor update. So let's write, okay, so what do we want to say about this? So I think we can say we didn't mention the 3 accounts that we had acquired. So let's say we converted 3 new accounts in April, up from 2 in March. As we continue to improve our sales process, we can also say maybe we knew anecdotally that word of mouth is driving increased organic leads and meetings, driving our top and mid funnel leads down, lead cost down. So you can see here, maybe our cost per lead went down, maybe our cost per meeting went down significantly. Effectively, what you want to explain is if your CAC went down, why did it go down? If your LTV went up, why did it go up? So you need to explain that story. These improvements drove CAC down 17%. I think that's 17%. 17%. And let's see how much our LTV to CAC ratio rose. 46%. Month over month over month. From 8,796 in March to 7,281 in April. And finally, between the increase in projected LTV and drop in CAC, our LTV to CAC ratio improved 46% month over month from 4.13 to 6.03. So that's obviously really good news. So that's going to give your investors a good sense of sort of how you're trending. Now we're going to talk about burn, runway, and then finally financials. So when you're talking about your burn rate, that's how much cash did your business burn in a single month. So the easiest way to do this is just look at beginning of the month cash and end of the month cash, and then how much cash was left over. So you had 744 at the beginning of the month, and then at the end of the month you had 695. So you burned $48,000. Same in April. We burned $36,000. So when investors ask, what is your runway? That means how many months of cash do you have until you have no more cash? So how many months of cash do you have for your business? So a lot of investors will just say, they'll take your end of month cash and you'll divide it by your burn rate. And so they'll say, okay, if they keep burning this amount of money each month, we have 14 months of cash. And if they keep burning this amount of cash each month, they have 18 months of cash. So a lot of investors do this even if you give them a projection and say, no, it's a specific month, they'll just do it like this. But if you do have projections and you're doing cost cuts or you have visibility into your sales, then use your projections. So like in our scenario, let's say in March we'd given guidance that we were going to break even by October. And then now we say we're going to break even by August because our numbers are looking really, really good. So use your projections if you have them. Okay, so we reduced our burn from 49K to 36K on the back of improved retention, growth, and reduced CAC. And then based on our forecasts, we expect to hit cash flow break even by August. Okay, so finally, financials. Here's how I recommend you think about your financials. So you want to be sending out a monthly report on the financials of your company. We're saying here that we had April 2024 actuals versus April 2024 budget. So budget versus actuals, sometimes it's useful. A lot of times what's more useful is just looking at April 2024 actuals versus March 2024 actuals so people can actually see the change in trend. Because if your budget wasn't very accurate, then sometimes it's just sort of noise. But in either of these scenarios, here's how I like to kind of compare the months. So you have your difference, and then I like to say like percent. So I would just take this number and divide it by this number. So, and then here, you can take this number divided by this number to just look at the sort of percent change. And so here's how to kind of do this. And we're just going to walk through the numbers so you can get a sense of sort of what they mean. And then we can just copy this over to the other column. So let's say we're really tracking everything against our budget. And so we say, okay, the actuals, we beat our budget. It was 67,000. So we beat our budget by 8,000. In terms of on the expense side, you do want budgets, especially on the expense side, to try to control your costs. So we're saying that we're basically right on budget in terms of cost of sales, maybe slightly over, but very close. And then gross margin, we outperformed by $8,000 because of the increase in revenue. In terms of operating expenses, we were generally under, so we were under by about $3,000. So that's good news. And so operating income outperformed on the gross margin, outperformed on the expense side. But one thing is that your operating income doesn't reflect your cash flow, because if you're capitalizing software development and things like this, it doesn't really flow through your income statement in the same way that it's hitting your bank account. And so you always want to look to your cash flow statement, and you'll see that your operating income in April was negative 28,000, but your actual cash burn was negative 36,000. So just make sure you're watching out to understand the difference between your burn rate and your negative operating income. So if we just look at kind of month over month actuals, we could also use this and say, growth was 22%. We know growth was 22%. In this scenario, actually our gross margin increased by quite a bit. We got a little bit of a higher percent on the gross margin, increased by 24%. Then we have our operating expenses were down month over month on increased revenue. So improvement in operating income, improvement in burn rate. So these are a good way to sort of track your metrics and then decide, what you're going to say about them. So here's like a couple ideas on what you could say. So let's say outperformed budget by 14%. 14% on revenue, and we grew revenue 22% month over month. So we know that. What else? Improved gross margin slightly from 87% to 88% from operating leverage. So that's here. You can see we're getting basically more margin. And so operating leverage, you'll hear this term sometimes. Operating leverage basically means more revenue / profits without increasing costs. So you have a team in place and you can continue to drive more revenue. So you're seeing flat COGS, but you're able to actually drive more revenue through the same hosting, support, credit card fees, COGS. And so that's called leverage. You're getting operating leverage out of a fixed cost base and then improved efficiency on top of it. Okay, what else? You have reduced overall OpEx by 2%. You can see here, month over month, driven by mostly by this. So that's consultants, driven by cutting redundant consultant. And then you can say operating loss narrowed from 41K in March to 28K in April. So that's a 32% reduction in operating loss. So you can see that here. And we already talked about our burn rate, so I don't think we need to cover that again. Okay, so now we've basically written our investor update. We just need to combine all of this stuff together. So here's how you write an investor update. So, okay, so let's organize this. So this is the kind of thing you'd want to write in an email at the end of every month. One thing about investor updates, most startups will write investor updates when their numbers are good, and they'll stop writing them when their numbers are bad. But investors know this. So if there's silence, investors generally are going to think that your business is doing terribly, because it's sort of a natural psychological thing to stop reporting bad numbers. But it's good practice to write an investor update every single month on a schedule, no matter what the numbers are. It's better. You'll be more accountable as a team. And also, if your investors can step in and help you, if they know what's going on, they're obviously going to try to help you. So it's better to do this. So the first thing in an update, you'd want to write like a couple highlights. So just as a summary, and then you can kind of summarize all the metrics below. So let's say in April, we had a very strong month. We generated a record MRR growing 22% month over month, along with a significant reduction in burn. So that's a quick highlight. usually include the good and the bad. So there weren't a lot of bad metrics in the data that we just reviewed, but you'd want to include like good, bad, and the ugly. Churn remained low at 3%. And we drove continued expansion revenue from existing clients. We expect to hit break even in August. And then if you have any asks, you could say, we are looking to hire a VP of sales soon. Let us know if you know any potential candidates. And then sort of do your overview. So here's how I would do this. I think you can just paste in what we already wrote below. So here's how I would just do this. So we have 2 lines here. And so I'll just skip ahead so when this is done so we can kind of look at this. Okay, so now I just linked in everything we wrote below underneath each of the 7 SaaS metric titles. And I can say April 2024, investor update, highlights, overview of SaaS metrics and KPIs. Just kind of put a box around this, and our investor update is done. So we wrote it as we calculated all of these numbers. And so you could send this straight out to investors. This would be a fantastic update, much better than most startups are sending. And it would give them a lot of faith that you are tracking the most important metrics. And it would also be very, very useful for fundraising because you'll be on top of your metrics and you could forward prior investor updates to new prospective investors who might be interested. Okay, so I hope this gives you a great understanding of the most important SaaS metrics and how to track the financial performance of SaaS startups. First off, as always, you can download this Excel model completely for free. Just look for the download link in the description below. Also, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. And if you want to support my channel, please like, subscribe, or leave me a comment. Thanks for watching, and I'll see you in the next video.